But the real opportunity in AI is not just in the software. Here in the US, we have a huge problem. In order to just meet the demands of the 7 largest hyperscalers, the Teslas and the Googles and the Microsoft and the Amazons, they have demand for 30 gigawatts of data centers, 30. And we used to build them at 50 megawatts. So that's a fraction of the size. There's only 5 under construction in North America right now. 45% of the data centers in America are in Virginia, but Virginia's just passed a law that does not let you put a backup generator on a data center. A data center today needs to be 5.9, which means it has to be up 99.999% of the time. I'm giving you a lot of data you'll find interesting. That means it's only down 14 seconds a month.
Kevin O'Leary highlights a major challenge in AI: the lack of infrastructure to meet the soaring energy demands for data centers. With hyperscalers like Tesla, Google, and Microsoft requiring 30 gigawatts of power, the U.S. faces significant hurdles, including regulatory restrictions such as Virginia's ban on backup generators. Building a single data center costs up to $4 billion, emphasizing the urgent need for improved energy capacity and infrastructure. While Meta has outperformed, most Magnificent Seven stocks have underwhelmed recently, sparking investor interest in smaller companies. Analysts note a rotation towards these emerging firms in frontier tech, which offer higher growth potential. Meanwhile, big tech continues to invest heavily in AI, with capital expenditures hitting billions, though concerns about long-term profitability and monetization persist. Despite the bullish outlook for AI, market sentiment has shifted. Rising tariffs, doubts about AI's development pace, and worries over shrinking profit margins are cooling excitement. The question remains whether this is a temporary adjustment or a deeper reckoning for AI's role in driving corporate growth.
What does it cost to build one of these? $2 billion. Just for the platform, and another $2 billion for the stacks of chips. $4 billion in the ground for a 1 gigawatt data center. I built those, and we can't get the power. I don't care what state you go to. You go to the power authority there and say, I just want 100 megawatts. Can't do it. We have no power in America right now.
Talk a little bit more about the underperformance of the other Mag 7 stocks apart from Meta. To do that, let's bring in Gene Munster, managing partner at Deepwater Asset Management. I'm prone to say that the Mag 7 has become the Lag 7, except for Meta. Gene.
Indeed, Tyler, the Meta's up 23% over the last month. The rest of the Mag 7 down 1%. If you pull Tesla out, that's been a big drag on that, it would be up 2%. So compare that to the NASDAQ over the last month, which is up almost 5%. This is definitely a different message that we've seen from this leadership group over the past couple years. And Tyler, I want to just quickly frame in why I think what is going on here. Beyond Meta, I think what is going on is that this is almost becoming a self-fulfilling prophecy, with investors just looking back and looking at these trillion-dollar-plus market caps and just mathematically trying to understand what percentage performance they can get relative to some other smaller names. And I think you have this dynamic playing out. In fairness to the Mag 7, I do want to quickly recap the scorecard from the December quarter. 4 of those 6 companies reported of the 6 companies, the 6 of the Mag 7 that reported, 4 had positive results. A couple had a little bit of hair on them, but all 6 were, I would say, doubling down and uber optimistic about how this year is going to play out, how next year is going to play out. And so I think the context of this is that the fundamentals continue to be strong. One last piece is, despite my optimism around the Mag 7, I do think you're going to see more outperformance from smaller companies. I think just at Deepwater, in terms of how we're investing, we're focusing still on the same themes, but companies that are kind of that sub 500 billion market cap in this frontier tech realm. So still own some of the Mag 7, but we've shifted some of our focus to some of these smaller companies.
So what you're pinpointing there, and I'll get Steve to jump in here in just a second. What you're pinpointing here is a kind of rotation that a lot of people have been talking about and expecting for the past year or so, and now maybe those days are upon us. Is that a fair characterization of what you're thinking, Gene?
Exactly, and I mean, I'd say that again. I think we own many of the Mag 7. I think they're going to do great, reward investors. But I think this outperformance piece is going to shift to some of these smaller companies, and ultimately, they are participating along with the Mag 7. They just haven't been this flight to quality. The key is this: as long as the broader market holds together, I think you're going to see better outperformance from these smaller companies.
So Gene, I'm going to pick right up where you left off. So when you look at the broader market is 40% dependent on Mag 7, pretty much. So without Mag 7, the broader market sort of fades. And we saw Meta, Tyler brought it up, $65 billion in CapEx. We saw Microsoft, $85 billion in CapEx. We saw Amazon, $104 billion CapEx. If DeepSeek threw the grenade into that pile, what are they going to pivot and spend all this money on? Even if DeepSeek is a scam, there's got to be some efficiencies that's out there that they don't need to spend what they're spending now. What do they pivot to spending on?
I think from the mega caps, it's still going to be AI. I think it's still going to be that same story that we've had. I still believe we're very early in this, and I still believe we're going to have a great 2-year bull market that's going to end in a spectacular bursting of the bubble. One piece to Steve, really quick. You talked about that 40% of the market, and can if the Mag 7 doesn't work, how can the rest of the market work? And I do believe that the Mag 7 will continue to work. I think that as long as they're moving higher, I think these other stocks will continue to do well. I mean, from our perspective, one thing, we have an ETF, and its ticker is LOUP, that focuses on these smaller companies, and it's been up 9% this year. As I mentioned, the NASDAQ up 5%. It's that kind of dynamic that we're seeing, and so we're closely watching this dynamic play out.
I was about to let you go, but I'm going to come back to something you just said. But I also want to get a couple of names in that sub 500, sub $20 billion market cap that have caught your attention. So give me a couple of names there quickly, and then I want to follow up with one quick question.
So one of them is Celestica, a name that many don't know. This is it's basically a switch company, competes with Cisco, gaining share. It's needed for the development. Another one is Reddit. Many know, but still, I think, underappreciated what they're doing with their data related to training AI.
Talk about throwing the grenade. I heard you say, if I heard you right, that we have 2 more years of a good bull market and then a spectacular bursting of the bubble.
It's going to be great. It'll be
going to be great, right?
Big technologies capital spending, better known as CapEx, expected to come in at around $320 billion this year, about a 40% jump from last year's numbers. However, investor sentiment around that spending might not be following the same upward trajectory, shall they say. Christina Partsinevelos, crunching the number. You literally took the numbers and you crunched them.
Yes, with an abacus. AI stocks, though, have seen a significant pullback in early 2025 after last year's surge. And you just talked about it, Brian. We know tech giants aren't holding back. Alphabet, as an example, alone is boosting its spending to $75 billion this year. That's 29% more than Wall Street expected. So massive investments, chips, servers, Ethernets, networking, you name it. But here's the twist, the number crunching you referred to. Wall Street's reaction has changed dramatically. So take a look at this chart. Last April, AI-focused companies, the obvious, Nvidia, Dell, Broadcom, saw their stocks jump when big tech announcements, or CapEx, was delivered. Fast forward to now, those same names, and I've included a few more like Arista Networks, Modine, Marvell, they're barely moving. We're seeing an average of just 1% last week, a fraction of last year's excitement after we saw all of those big CapEx numbers. So what's behind this market shift? Well, analysts kind of point to 3 key factors. First, you have concerns about tariffs. So investors are looking for safer havens, like software, for example. And you can just see that just in the shift of the IGV, which is a software ETF. It's up about, 9% just in the last month versus the SOX ETF, a good barometer for chips, and that's not up as much. It might be around 2%. Second, you got the DeepSeek headlines that have some questioning the pace of AI development. And then perhaps most importantly, Bank of America is warning that all of this AI spend could start eating into profits, those margins, even for the mighty Magnificent Seven. The big question now is whether this is just a temporary cool down or a sign that Wall Street is really starting to take a more realistic view of AI's near-term impact on corporate bottom lines, aka monetization, Brian.
That is the question. Christina Partsinevelos, we will see you soon.
Kevin O'Leary discusses the massive energy and infrastructure challenges posed by the rising demand for AI-driven data centers. Major companies like Tesla, Google, and Microsoft require 30 gigawatts of data center power, but the U.S. struggles with limited energy availability and restrictive regulations, such as Virginia's ban on backup generators. Building these data centers costs billions, with a single 1 gigawatt facility requiring $4 billion, creating significant barriers to scaling AI capabilities. Meanwhile, analysts note a shift in investor focus from large-cap, Magnificent Seven stocks like Meta and Tesla to smaller, underappreciated companies in the tech sector. While big tech continues to pour billions into AI development, skepticism grows over AI's short-term monetization, with concerns about tariffs, slower innovation, and shrinking profit margins. The market's sentiment suggests a cautious approach to AI's potential impact on corporate growth and profitability. What strategies can address the energy and infrastructure challenges of scaling AI? Will smaller tech companies lead the next wave of AI innovation over big tech giants? Let me know in the comments.